So I think that right now we have a problem in that a high enough interest rate to adequately control inflation. So I believe that we're entering a period which it's going to be very, very difficult for the Fed and for other central banks to try to find that right balance. They're going to navigate between those two things. Too tight means a bad economy, and too loose means a bad inflation. And I think that difference is going to produce more of a stagflation type of environment.
Ray Dalio is an American investor, hedge fund manager, and a philanthropist. He is the founder of Bridgewater Associates, one of the largest and most successful hedge funds in the world. With a few decades lasting career, Dalio proved himself as one of the leading people in financial sector, and he is acknowledged for his innovative investive access and risk management. In 2023, he has an estimated net worth of around $20 billion, which makes him one of the richest people in the world. Watch this video until the end and find out his opinion about the current situation, inflation, Bitcoin, as well as his investing advices.
I don't know, 8-10 years ago, I began to see things that didn't happen in my lifetime before, but happened in the 1930 to 45 period. And then I thought I better go back and study the rises and declines of reserve currencies. First of all, there are two types of inflation. There's the supply-demand inflation, when demand is strong enough and it presses up against capacity, like you don't have enough labor, unemployment rates are low, and capacity is low, and then prices go up, and there's that kind of inflation. And then there's a monetary inflation, which comes from the supply of debt being too much so that they produce more of the money, and the holders of those financial assets, particularly bonds, because bonds is just a promise to receive money that the central bank can print, the holders of that then go into those other things. And then what happens is then you just have to follow the money. So you see who gets the money. And then when they get the money, you see what they do with that money. But the big monetary inflation is the thing. Where do I store my wealth? Okay? Because what happens to the markets is then when you go to those other things, let's say you go to stocks, you go to real estate, you go to other things because they're getting out of that. As those prices rise, like a bond, their future expected returns go down. And as they come closer to the interest rate, so now you've got whatever the interest rates are, it depends on the country, but it comes down, then there's no longer the incentive to buy those things, and you could have trouble. And it becomes very difficult to tighten monetary policy because the whole thing falls apart. You know, everything's interest rate sensitive. And so the central bank has got to then print that. Then you have negative real returns in stocks and other assets, like we did in the 70s, but the nominal return goes up. That pattern has happened over and over, and I'm just trying to describe the mechanics of it.
This year we've seen institutions like yours. I mean, I don't know whether you guys have actually bought any Bitcoin, but I certainly know that you're interested in it. We've certainly
I have some Bitcoin.
So we've certainly got a number of these big institutions now buying into that. However, how important is that institutional buy-in from a political perspective? Does it impact the policy decisions going forward, whether it's for Bitcoin or for any asset for that matter?
Yeah, I think Bitcoin's greatest risk is its success. Because as it becomes more, right now, it's not such a big deal. And, you know, fighting it is more of a big deal. And that's it, because it's not that big a deal. As it becomes a bigger deal and more of a threat, let's say people want to sell their bonds and they want to buy Bitcoin, and they want to do that in a bigger way, like buying gold or something in a bigger way. And then there's more transaction. They lose control over that. And that's an existential risk. So yes, that's connected. The more we create savings in it, the more you might say, I'd rather have Bitcoin than the bond. Personally, I'd rather have Bitcoin than a bond. And then the more that happens, then it goes into Bitcoin and it doesn't go into credit, and then they lose control of it. So yeah, that's a risk. Watch the total value of Bitcoin right now is a little over $1 trillion. Total value of bonds, about $23 trillion, and so on. Not only watch the price, although in Bitcoin's case, the demand follows the price, watch the total values of those things. And as those, plot it on a chart and watch those things and watch the flows, because if you start to see that kind of thing, you could almost see, like the blow off and then that kind of reversal.
What does a smart portfolio look like with that in mind, but also obviously the bigger, international hegemonic issues that you were talking about?
Well, I think the same thing. These things come across about once in a lifetime, the problem with most people is if they didn't experience it, they don't understand it. Because it's like, if you were in the 20s, you're experiencing the 1920s and so on, and you cannot imagine what's ahead because it hadn't happened in your lifetime. The New World Order. So we're in a spot of the cycle. It's not just about interest rates. It's about the whole enchilada, and that could be financial, which has to do with taxes, and then trying to escape taxes, and then trying to control, and all of that dynamic. And then it has to do with conflicts between the left and the right, and the capitalists and the socialists, and how they can be with each other. That affects the environment. And then it has to do with the changing world order in terms of China and the United States and so on. So your children will really, in order to understand what's likely to happen over the next 1, 2, 3, 4, 5 years, you really need to go back and study what happened in the 1930-45 period and so on and so forth, because you've got to be prepared for all of those possibilities.